Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Within financial markets, derivatives have always been the stomping grounds of those inclined to entertain probabilities and models. Delving further within this space, you'll find simpler, vanilla products like listed options, but also a realm of considerably greater complexity where counterparties engage in the transfer of alternative risk exposures. For French banks like BNP, derivatives innovation has always been an important part of the value proposition. And as head of sales for the Americas at BNP, Nathalie Texier Guillot has been an important driver of the bank's mission to help clients solve complicated problems. My conversation with Nathalie considers the current state of the risk recycling business in light of the explosion of volatility during March of 2020. She provides insights on the importance of sizing trades properly, her observations on dislocations that emerged earlier this year, and the types of trades she and her team are spending time on now. We also discuss the challenges in leading a team during the work-from-home era and how technology is being used to enhance the experience. Lastly, we discuss the important mission of advancing the careers of women in finance and Nathalie's views on how to best advocate for the cause. I hope you enjoyed this episode of the podcast as much as I did, and thanks for listening. My guest today on the Alpha Exchange is Nathalie Texier Guillot. She is the head of equity sales for the Americas at BNP Paribas. Nathalie, thanks for taking the time to join us today.
Thank you very much, Dean, for having me. Certainly very unusual time right now, very disruptive to our way of life. But again, very happy to be here to discuss market today with you.
Yeah, well, we sit here in the midst of the summer, 3 or 4 months into the pandemic and a massive reaction in markets, an economic shutdown, big government and Fed response. So we'll have tons to dive into as we get our conversation underway. I'd love to learn a little bit more about your career trajectory. You've risen to quite an important role at BNP. How did you get started in finance? How did you develop a passion and interest in this field?
I spent most of my career in sales in the U.S., covering U.S. clients initially, and then North American and Latin American clients. I think I had the opportunity to get experience of both fixed income and equity. So I started in New York as a fixed income sales. Then I moved to Europe and switched my product focus to convertible bonds. And finally, I settled for equity derivatives back in New York. I think one common denominator has been my client base. In other words, I'm institutional clients initially. So that's definitely the core and the denominator of my career. So prior to BNP, I spent 7 years at Citigroup, where I built up their equity structured business for institutional clients. Later on, asked to reorganize what they called the multi-asset structuring team. And for me, it was a great opportunity to actually learn more about also structuring, cross-asset structuring, and distribution business in the Americas, so both North America and Latin America. I think, as you mentioned, that's kind of an unusual path. I mean, there's definitely no doubt that moving from one asset class to another can be quite challenging. I do believe that that's what had made me a better salesperson. I think the multi-asset experience helped me better understand client portfolio. And I think nowadays clients are definitely trying to have a much more cross-asset approach in their portfolio construction or the investment process. So through that experience on the multi-asset side and also through my experience through structuring, I think being able to foster my curiosity, also like trying to develop a different approach of client problems and to be more critical about the solution I was bringing to them. So again, I think it's just moving from one asset class, taking those challenges shows that you can handle change. And again, having a different approach to your client than maybe other salespeople.
There are differences in some ways between the large U.S. banks and some of the European banks, just in terms of their DNA. Of course, large banks like Morgan Stanley and Goldman Sachs are in just about every product across the derivative spectrum. They tend to be a little bit more of the blocking and tackling on the vanilla side, whereas European banks and French banks in particular they take derivatives incredibly seriously and are very involved in some of the second and third order innovations in the derivatives market. Maybe you can just walk us through the DNA, so to speak, of a French bank in terms of structuring in the derivatives space. There's a lot of innovation. What is that about? Explain to us exactly how a BNP thinks about the world of derivatives and how it might be distinguished from a US bank.
I think you're right. Historically, European banks have been focusing more on structured business. Mainly, I think because of the education and a lot of engineer coming into the financial industry in Europe. And it's true, BNP is the leader on structured product in Europe and in Asia in particular. And we've been focusing more on bringing innovative solutions to our clients. That being said, the reason why we think your question is very timely is that we've had this vision to grow now derivative franchise. And for BNP to grow that franchise, we need to grow in the US. And again, as you mentioned, a large part of the derivative market, it's in the flow side, flow business in the US. So that's something that we are looking to grow. Obviously, our DNA remain the structured business. But if you want to stay relevant with your client and you want to expand your client reach, I do think you need to expand the range of the products you can trade with those clients. And that goes from the very vanilla to the very complex. You want to be the one-stop shop where the clients, when they have a problem, come to you because they trust you can come up with a solution. But the solution doesn't necessarily need to be super complex. It can be a smart, innovative solution, but in a very vanilla format. So again, we still want to be the bank and the European bank, I think in general, wants to be the bank where clients see them as the innovator. But nowadays, I think it's not just coming to European bank for complex solution. It has to encompass also, I think, the vanilla product.
Our audience of listeners tends to be pretty sophisticated from either the sell side, the buy side oftentimes, and certainly the allocator community as well. But they may not have a real deep background in this business of risk recycling, which is a pretty interesting part of the street where there's a transfer of risk. I was hoping that you could step back and just because you've been a part of this industry for so long and done some innovation in it, what does risk recycling mean from your standpoint? Maybe you could just broadly describe to us the types of activities that occur in this corner of the market.
European banks have been very active in creating retail product, and that's a business that have grown over the years. It's a good business for the bank. They like that type of business. But over the years, as the business have grown, they've been accumulating risk. Typically, the structured retail product will tend to be worst of calls, basket of stock that actually leads the banks, usually short correlation, long volatility, will create some risk dividend side and then the repo side. So as actually the inventory of this product increases and the regulation starting to be a bit more strict for banks, the banks have had to manage those inventory and find ways to share that with investors. And actually investors have been very welcoming with those type of products as they were looking for new ways to generate returns. So actually what we call ART, which is alternative risk transfer. I think the first trade we did when I was in the previous shop was back in 2003. It's not a new concept, but I think that we've seen more of those activities because how quickly the retail structure business have grown on one side, and at the same time because there's demand from the investors from both the hedge fund industry, but also from real money accounts like pension asset managers looking for those type of returns. So as of today, I think because of the regulation that impose stricter guidelines around banks and banks need to actually more actively manage their inventory, that's a business that has grown and is going to keep growing in order to provide the ability to banks to continue to sell structured product to retail investors.
So coming into 2020, we'd had a reasonably long stretch with some blips along the way of markets that were pretty well behaved. Certainly had risk offs in things like 2015 with China or the XIV unwind in 2018. The end of 18, we had another risk off. Perhaps the Fed was tightening too quickly. But for the most part, markets were reasonably calm. What was over that period, the buildup of exposures? And I guess what I'm getting at is as we came into 2020 and as this virus became a big deal, what was the setup in the risk recycling part of the market? Were end users overly short or long any types of complex exposures that played a role in terms of the unwind? I'm curious what the setup looked like coming in to March of 2020.
So I think if you look at, so maybe some observation, the past few years before we focus on the COVID crisis, I think one of the most interesting things we've seen in equities has been this persistent low vol environment, to some extent fatter tails. The fact that the equity volatility has been consistently and artificially suppressed by central bank, and especially by the Fed, have kind of incentivized investors to go down the risk curve in search for yield. If you look at the risk recycling, a lot of those trades tend to be carry trades and trades that actually banks like, but they have to share with investors. So that's going to be position like short volatility, short correlation, long dividends. So we've seen as vol remain quite low, investors looking for ways to generate additional return and also looking for ways to diversify their risk across products. So at the end of the day, all those carry trades are statistically like positive expected return. For me, it's all about sizing appropriately those risks within your portfolio. And obviously also monitoring the entry point. But I think the most important thing is how you size those risks within the framework of your portfolio.
You make such a great point on sizing. It would seem like a lot of these trades, they backtest quite well. They do pretty consistently well through time. They get nicked up in periods of dislocation, but the sizing seems to be where folks either get through it okay or wind up in real trouble. When you think about maybe the concentration of trades in the spectrum of complex risk that was the setup coming into 2020, were there risks that were just overly sponsored in the market in terms of too many people had the same trade on? How much does that figure into the explosion of volatility that we saw?
I think it's initially linked to those risk recycling. I think something that clearly we've seen, it's the importance of positioning over the last few years. I mean, on one side, you had this persistent low vol environment that has kind of pushed investors to take more risk and look for alternative ways to generate returns. And on the other side, you had this growth of passive systematic strategy. And those two combined have had a significant impact on market structure. And I think that positioning nowadays is very, very important. And clients have been asking a lot about the market structure, the positioning, because that's what has been driving the market the past few years increasingly. And the market in general seems that has been much more fragile. Markets in general have been much more fragile and much more vulnerable to any type of shocks. You mentioned earlier, like Feb 2018. So what we'll call like Volmageddon, it's a really good example. That's where you had this accumulation of risk to the ETPs, the VIX ETPs, which led to this acceleration on the volatility back in 2018. Increasingly, those positions are creating the domino effect, and in the case of the VIX, you had the domino effect as vol spike. We had this volume spike that has triggered kind of a massive deleveraging also vol target funds. So everything's very much linked on because of this huge positioning, the fact that you have many credit positions and everybody kind of looking for the same trades.
Yeah, it's great that you mentioned vol targeting funds. It's an interesting dynamic where the vol itself is an input level into the sizing of trades. Chris Cole, who runs Artemis, has likened it to volatility not just being a kind of a statistic in the game, but also a player on the field. It's a very complicated way in which it interacts with the market. You've done a lot in structuring across asset classes, multi-asset structuring. And I was hoping you could one, explain what exactly that means? I think some viewers are just used to thinking about one market in isolation, but it sounds like you do a lot across different asset classes. And just hoping you can provide an overview of that and then some of the things that perhaps were important through this crisis in terms of that cross-asset relationship.
When I was running the multi-asset structuring team, it was more about hybrid trading and also building what we call quantitative investment strategies, which is ultimately it's an area that have grown a lot across the banks, and we've seen increasingly demand from our final investors, both on the retail side and on the institutional side. So that's something that I've continued to develop here at BNP, which is trying to expand a systematic strategy across asset class to provide investors ways to implement those rule-based strategy in a cost-effective manner, but also very transparent way. And that could be actually interesting enough. Yesterday, I was talking with a colleague of mine that not only pensions, asset managers looking at this type of strategy, but also some hedge fund trying to find ways to implement interesting strategy, again, in a cost-effective manner with a quick implementation.
When I think about cross-asset structuring, the word correlation kind of pops up, at least for me. And I'm curious in terms of how you think about finding opportunities, are there specific correlation relationships that get to extremes to some extent that might be tradable, or there's value to extract from the way in which correlation relationships evolve? And if so, what kind of correlations do you spend your time looking at?
So more recently, I spent more time focusing more on equity. And I think there was this crisis during the COVID crisis. You've had like a very good opportunity and dislocation in the equity world. And we can definitely discuss those. I think they've been combined with the fact that banks had to buy back some risk. And I think you had good entry point back in March and even right now for investors to implement some trades from a carry perspective, being selling correlation between global indices. If you look at Eurostock, S&P, Eurostock, HSCI, for example, through the crisis, those correlation hit like historical highs around like mid-80s, mid-70s. And you've seen investors taking advantage of the fact that the dealers had to buy back that correlation to put those trade on in the midst of the crisis. Another big dislocation that we saw and where something dealers had to buy back smile on indices, being on S&P or Eurostock, those were good opportunities for clients to implement new trades. So very interesting one actually that I like because we did that with as a partnership with a couple big clients was to extract the convexity on S&P or Eurostock, for example. And one way to do that is to sell variance swap on the index for S&P or Eurostock against a strip of options to replicate the variance. And if you really want to mitigate your downside risk, you can combine that with the purchase of out of the money put. So the whole idea of the trade being shorter variance, long variance swap replication through a strip of option allow you to collect carry. And again, if you want to mitigate your downside, you can add an out of the money put, could be a 50% put. And that way, not only you mitigate your risk, but also you can actually enhance your return if you have a big move down during the life of the trade.
A lot of what you and your team focus on is on the alpha side of things, trying to find correlations or vols that you can lean against to try to generate alpha. But there's also a defensive part of the business, hedging. And of course, through the crisis, hedging became incredibly expensive for good reason. And even now, several months after the peak of the VIX, it's the case as well that option premiums are so high that it makes hedging really difficult to stomach in terms of the costs. What are the types of clever trades that someone might think about? Let's, for example, say that someone's concerned about the election. Are there products of trades that folks can think about that economize a little bit on the option premium to try not to pay away so much given how high implied volatility is?
I mean, Definitely the VIX, it's a good tool to play the election. I think investors are starting now to look at some implementation around the election. Until recently, that was kind of too far away, and they were focusing more on more tactical trades. And I have to say, a lot of clients have been very tactical because due to the lack of conviction and also the underweight positioning in equity. But going into the election, yes, definitely, there's various option strategies you could put in place using VIX to play the November election.
Got it. And as you think about just the crisis itself, we're a couple of months, as I said, past the peak of it. Were there certain dislocations or just the speed of things happening that really stood out to you? Or there are a couple of relationships that became excessively unglued or things you just never thought you would see in terms of market prices that you can share with us? It was obviously an incredibly tumultuous time period there.
Yeah, I think one of the most notable observations of the crisis in the velocity of the drawdown. We saw, I think, like a 35% decline over like 33 days. So that's roughly 1% per day over like maybe a little bit more than a month. So that's basically the fastest US equity crash on record. You think about it, the VIX peaked, I think, 83%, which is the highest since its inception. And I believe it was higher than 2008. One thing that actually our strategy team has developed in-house, it's a VIX model to compare the different crises going back 100 years ago. And actually doing that, they point out that actually the 2020 VIX peak, actually it's the third highest after 1929 and 1987. But in terms of velocity of the sell-off, this year crisis has been the largest in front of even like what happened in February 2018. So I think it's definitely quite interesting to see also how positioning has played for the role in that acceleration on the volatility.
Coming into this, it was always the case that some of the global vol trades that were pairs trades had an S&P short leg to it. It was always buy something versus selling the S&P. Do you think that was complicit in the VIX getting to 83? Was that the short leg of S&P vol was so well sponsored? Is that part of the kind of outperformance of S&P vol versus some of the other indices?
And for this sell-off, I'm not so sure. I think it was, again, more about positioning. I think how the quant strategy were positioned, being the CTA, the vol target, the risk parity, and also what was the dealer gamma profile at that time. Definitely the exotic product had some impact, but I think the fact that you had, like the low vol have kind of left the the investors have long equity. If you were looking at the vol targets or the risk parity of the CTA, they were highly levered. And by following this big move in vol, you have this massive deleveraging of the different strategy, which had this domino effect, very much like you had also in 2018. So that's why I was mentioning, I think more than structured product or the positioning from the dealers of the fact that the S&P was a funding line, I think was the positioning, having all those passive and systematic strategy positioned the same way and having to reduce their equity exposure in a very quick manner because of the vol spike. Now, it's worth highlighting that right now, the positioning backdrop is much more different today than it was 5 months ago. So if we were to have a second leg lower in spot, like a second wave or something, I think the move will be much less exacerbated due to the deleveraging of the vol control strategy. Because usually what you see is that the deleveraging tends to be very rapid, while the releveraging definitely much slower. So as of today, 5 months into the year, most of the strategies, the vol target strategy or the risk parity, are still not fully back to where they were back in December or January of this year.
There's a lot of work that's done on the street that tries to calculate the mechanical either leveraging or deleveraging that comes from either movements in spot or changes in volatility, as you're noting. Sometimes it feels a little too pinpointed in terms of this is exactly what will happen. I think that's a very complex set of exposures, and how people react is always unknown. One of the things that on the US side people assume is if we shock the S&P down, the dealers are short this much gamma, and this is the amount of selling that has to occur via delta hedging. On the complex side, it seems a little different, and I'm hoping you can just provide a little context here. At least what I understand on some of the complex books is that they actually, by virtue of some of the knockout features that are embedded in the products that the end users buy, the dealers sometimes get longer vol on the way down. It's a little less clear. Is that something that you can speak to, and just in terms of the sort of orientation around these complex books and how the interaction between spot and vol takes place?
Yes. So because of the structure of the different structured products that are being sold to retail investors, the exposure to volatility or to dividend or to repo to a certain extent tends to be spot dependent. So that's why, as you mentioned, like as spot move down or up, the exposure for the dealers will vary with that spot. So you have what we call like a peak vega, where as spot move down, there's an accumulation of exposure across the different dealers or sell structured product. But at a certain point, past the peak vega, the sign of the vega may flip from positive to negative. So that requires dealers to be very active in their management of that position. Again, there's a lot of talk about that peak vega. There's no golden numbers. I mean, it's like each dealers will manage those positions differently and more or less actively. But it's true that there's some areas of spot where you will have some heavy action as the dealers need to manage those positions as you get closer to that peak vega, where you have a flip of the signs for their vol exposure.
So we talked a little bit about the concept of peak vega in the market, in the structured products market. And I thought it would be helpful for you to share some more around that interesting dynamic and how it fits into how investors perceive the risks in the marketplace.
The autocall product is a structured product that has a no-cat features on the upside, as you mentioned. And they're all pretty different, but most of them offer high coupons when the note is being called. Also, you have a sold knocking put, which is often embedded to reduce the cost of the structure. So the growth, I think, of the autocall business have kind of played an interesting role in the volatility market, especially in the last crisis. And as you mentioned, the no-cat feature on the upside can create some deformation of the issuer or the dealer risk as spot moves. And the management of those positions can be quite challenging from the dealer perspective. And in other words, it can be costly from a hedging perspective in period of high vol or even low liquidity in the market. So when the dealer actually issued the autocallable note, they are long vega, and they become longer vega as the underlying force. So until we hit what I mentioned earlier, the peak vega, the dealers have to sell volatility to hedge their vega exposure. However, as we approach that peak vega and the underlyings continue to fall towards the knock-in barrier, the vega profile may start to change and in fact may begin to decline. So this may cause the dealers who was previously selling options to hedge their vega exposure to now start buying back volatility, which can actually put upward pressure on the volatility market. So there's been a lot of talk about, where's the peak vega, as investors were trying to figure out where the sign of that vega exposure for dealers flips from positive to negative. I don't think there's any magic numbers. I mean, there's so many issuance, and plus dealers don't really hedge their structured product one by one. They tend to manage more their inventory as a large portfolio of structured notes, which in fact may smooth the barrier impact. But if I had to kind of give an estimate of where you may see some action, it tends to be between 25% and 30% below the spot level where actually the notes are issued. And I think that's where you start seeing some action from the dealers. But again, all depends on the structure and all depends on the nature of the portfolio that the dealer will manage. But the interesting thing, I think, is the switch of Vega exposure at some point for the dealers that can make the management of the structure notes and the autocall notes in particular quite challenging in period of high vol and in some cases like low liquidity for those dealers.
In what indices would you say that this sort of dynamic in terms of volatility and peak vega is most prevalent?
Well, in the past, obviously you had, and I think a lot of people remember, the big move in the Korean market, one of the largest structure note market in the world. But more recently, we've seen action in Eurostoxx, and that's also why we've seen the downward pressure on long-term vol on Eurostoxx. So because of the amount of structural product issued on indices, including either basket of indices, including Eurostoxx, or simply just on the Eurostoxx indices. That being said, the U.S. market is growing, and you're starting to have more, like an increasing exposure on basket of U.S. indices, like Russell, S&P, or a mixture of global indices. So you will, I would say, on the largest indices, that's where you could see some action and some impact from those autocall notes.
As you describe the products, they're complicated, and it does appear that every couple of years, a dealer seems to find themselves in a position of perhaps mispricing the risk or mismanaging the exposures, leading to losses. What are the takeaways just from all of your time spent looking at these markets from a risk management standpoint? What do you feel are the commonalities when we read about a dealer who's lost a sizable amount of money trying to hedge these products? What do you think goes wrong most typically?
Again, I think it goes back to what I was saying earlier for clients when you are adding risk on your book. It's all about sizing and making sure you monitor those risks appropriately and ensuring you have the liquidity and you have the right metrics as you add risk. I think it's like any other portfolio or trade that you put in place. You just, like those structure notes tend to be challenging to manage because of the deformation of the risk due to the spot. So again, it's all about, the size of that book and the ability to monitor carefully and quickly, fast enough to react to the move in the market. And that's even more important that lately over the last 10 years, we've seen an acceleration of the number of crises and especially the violent moves we've seen in each of those crises. And again, like the positioning is having an impact, like the fact that you have the growth of the systematic strategy, the passive investment, which create that, sometimes some overhang on at certain level of the spot. So again, it's all about, I think, like sizing and the ability to react fast and monitor properly all the risk.
That's very interesting and just such a complex market that really is, to me, the centerpiece of innovation, just in terms of derivatives and product creation. Well, let's, if we can, shift from market prices and complex things like vol and correlation to the business of running a team. You're in a very senior role. You've got a number of direct reports and lots of clients. We're in a work from home environment in many cases. What has that been like for you in a management position in terms of running your team? How has the last 4 months gone? And what have you and your organization learned, and what does it mean for how you run the business going forward?
So the COVID crisis it's been extremely disruptive in the way we operate, the way we interact with people in general. I think not just in the financial industry. We've had quickly need to adopt, like technology, find ways to connect with people. And I think during the crisis was all the more important because of the uncertainty and the fact that that crisis was not like in 2008, where it was a financial crisis, with banks in the middle of that storm. But like in this case, it's more like the way of life and our families were affecting. So I think one thing that was very important for me is to stay close to my team, but not just with my direct, but with the entire team, and ensuring everybody continue to connect on a daily basis and trying to understand the various challenges that each employee will face. So it goes from Bloomberg chat, phone call, then ultimately we migrated to WebEx. Nobody likes change, so it took a while for a lot of people to adapt to those different technology. But through the new technology, the new platform, I think now the teams are able to connect multiple times during the day, not only on the sales side, but also on the trading side and the structuring side, on the strategy side. So I think that connectivity is essential, especially during stress time. So that was the first thing that was implemented, is the connectivity. Now, we need to continue business. Very quickly, we had to make sure, we're organizing sales meetings, morning meetings, changing idea, figuring out how to approach clients, how to continue to be relevant to our client and pitch ideas. Again, the usage of WebEx, more than phone calls, because you want to see people, even if it's not physically there, but like actually have this connectivity through the WebEx, the camera. I have to say, we realized that we don't need to travel all the time, and you can very well connect and discuss like complex solution with clients through WebEx. And we've closed like some large transactions during the pandemic, even if everyone was at home, thanks to those new technology. I think that will have a lasting impact of how we do business going forward. We certainly will have to travel again, and I think there's nothing is more valuable than face-to-face meeting, but we are trying to be more impactful on the climate change issue, using those new technology to reduce traveling while still remaining relevant to our client. I think are going to be very useful.
I think, as you're alluding to, our business is about products and solutions, but it's also about that human touch and trust, and just finding ways to enable that building of rapport is certainly something we all have to concentrate on a lot. You and I met a couple of years ago through an event that I organized, The Future of Finance is Female, and it was great to hear your story in front of a large audience. I'd love to come back to it, and it's been 2 years since we hosted the event. What is the future of finance in terms of females? How is that going? I know you've been involved in some initiatives on behalf of BNP and in other contexts. What do you see there in terms of the sponsorship of women in our industry?
So the industry is still very much male-dominated. So we made progress. I think the stats are getting better, but there's still too few women or females on top management or senior position. And it's not just in the financial world, but like in finance, definitely. And I think one of the biggest hurdles is to get women through the mid-career phase. But that being said, I think I'm very hopeful that this stat will continue to improve. I think there's more and more role models in finance, companies in general, and I think companies recognize, the positive impact of having a gender diversity. Your HR or human resources are more and more involved and putting in place programs to attract more female talents and to ensure that there's a more balanced workforce. Also, you've seen that there's an increase, more and more women association within banks. And at BNP, for example, we have a group called WIGAM, which is Women in Global Markets, where actually we get together on a regular basis, now virtually, but before like at the bank, just to kind of find ways to help the junior talent, junior women, and help them navigate the career. But like that's going to be preparing them for the interview for the director promotion, for the MD promotion. So I think the whole idea is like, how can we provide a support system within the organization to help make sure that those young talent actually raise their hand, ask to be promoted, ask for a bigger assignment, and feel okay to ask for more. So I'm hopeful that things are getting better. I think as a senior woman, my role is to make sure I can show them that you can be successful in senior role, still trying to maintain work-life balance. It's not easy. And I think, again, it's interacting as much as possible with younger women to listen to them and try to address, the various challenges. And I think COVID kind of was very disrupted. It kind of showed also like the fact that women being working parents could be quite challenging. So that needs to be addressed also in the context of COVID.
You've done a lot in this space. There's a lot more to do. And part of it is about finding the right mechanism for sponsorship of women. What's on your mind these days as we're in this new normal makes recruiting and networking more difficult? What are the types of initiatives that you think are even more important to be thinking about with respect to the advancement of careers for women in our industry of finance?
Well, I think we talk a lot about like mentorship and sponsorship, and I think both are very important, especially for females, but they're still quite different. I think they both can greatly help your career, but in fact, I think the sponsorship is even more crucial to ensure that you have a successful career. So on the one side, you have mentorship that it's very important. I think when you start your career and as a young professional, you need some kind of guidance, and having a mentor can provide you with some perspective. And I think it will help you understand and navigate better the organization you are in, also understand better maybe the unwritten rules, and again also help you, the mentor will help you to recognize your strengths and your areas of development. So I think mentorship is key, especially for young professional, and could be very impactful as you grow as in your career. Now I think the sponsorship is a bit different. The mentorship is kind of one way you receive from your mentor. You're trying to get as much advice from the mentor. The sponsorship, I think it's more a two-way street, because it's as much work on both sides, because the sponsor wants to make he or her protégé look good, and the sponsor role is to make sure that you accentuate the strength of that sponsoree, I guess, in front of the management. So I think the protégé will help understand on the other side of the spectrum, will help the sponsor actually look good by impressing the senior management how actually the sponsor has been able to spot a good profile or someone who has a great potential. And it can, so again, I think it's a two-way street. The sponsor will choose, wants to choose the right person so they look good within the organization to identify talent. And also the sponsor will help the protégé to build their own network within the organization. So in other words, I think that the sponsor has a vested interest in the protégé career growth, and it requires effort on both sides. So I think it's a very powerful way especially for women, to gain visibility if you have the right sponsor, and to make sure that you are tapped on the shoulder where there's some opportunity, making sure your name is being remembered in meetings when there's a project. So again, I think it's important to consider both. They are going to be important depending where you sit in your career, and those are like a good tool, I think, to continue to grow and get more advice from. Especially, I mentioned earlier like the importance of role model, but the sponsor doesn't need to be a woman; it can be a man. I think the most important thing is to ensure that the sponsor actually has his vested interest in making sure you look good and to make you grow within your organization.
Well, you mentioned female role models, and you're certainly one of them. So I wanted to say thank you, Nathalie, for taking the time to be on the podcast today. I thought this was a great conversation. I'm glad we finally got a chance to do it. And I wish you and your team and your family very best.
Thank you. Same for you. Thank you very much, Dean.
Thanks, Nathalie. Take care. You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.